Good morning, everybody. This is Hunter Satterfield, the Chief Investment Officer here at Kane Waters and Associates, as well as one of the partners. As always, today I am joined by my fellow partner, Brian Bortz, who is the head of the CWA Investment Committee, as well as Brad Sanders from Tectonic Advisors. He's the managing director over there, and their entire team supports our investment committee on an ongoing basis. So, gentlemen, as always, great to have you. Everyone, this is your March investment update. For the month of March, the S&P was off 5.5%, with global stocks off right around 4%. Here at Kane Waters, we are super optimistic. So bonds were up 0% instead of down 0%. And global bonds were up 0.6%. Brad, I want to immediately come over to you, and I'm going to reference one more number here, folks, as I go over to Brad. So the Magnificent Seven stocks just for the month of March, were off 10%. So that obviously is a core reason, Brad, why we saw the volatility and ultimately the negative month in the equity market. So coming over to you, obviously all the talk is tariffs. And that is certainly one of the things that's creating the volley back and forth in both the equity markets and the fixed income markets. Can you talk a little bit about what your team is seeing in both of those markets and sort of the impact of the administrative policy that's going on right now?
Sure. I guess I'll start by saying the broader markets are outperforming. So if you're looking at the S&P 500, and we've kind of talked about this ad nauseum, but we entered the year with the Mag 7 being about 35% of the S&P 500 index. And as Hunter mentioned, that was down 10% in just March. So that's about $2 trillion when those are down 2% or 10% that's getting reallocated. And if you look at the S&P equal weight, it was only down a little over 3% for the month. So it outperformed the cap weighted index by 2%. And so what I think you're seeing is a tremendous amount of volatility from the tariff policy that is really hitting the kind of expensive part of the market and the overinvested part of the market. But you're seeing pockets of the market and the broader market show a little bit more resilience than you are the cap weighted indices, and we think that's going to continue. And the bond market, to Hunter's point, it was a positive because it was up 0.04, but we round up for that slide. The 10-year Treasury is down to 4.2. If you're in, good credit's performing well. The bond market's up around 2.5% year to date. So we're, our bond portfolios are doing pretty well year to date, is what I should say. So that's protecting us, and our kind of standard models are doing really well. The tariff policy, what is really causing this amount of volatility? The policy itself is not helpful in terms of growth and economic activity, and there's a lot of shaking out that needs to happen there. But what is really causing this amount of volatility is the uncertainty surrounding it. The policy, they'll get mentioned, and then a month, like a day later, it'll be like, oh, we're going to temper that, or we're going to pull it back, or we're going to work with them, and it's not really going to happen. And that's the number one thing the equity markets hate is uncertainty. If you're not deliberate about what you're doing, the markets are going to try to price things, and there's really no way to price it. I've talked to all our fixed income managers this month. They collectively manage over $3 trillion. They have teams and teams of economists. PIMCO has Ben Bernanke and Alan Greenspan as their advisors. So they know how the Fed is going to react to data. And even they are wildly disparate in what they believe is going to happen. So that just shows you that this amount of uncertainty, it's going to filter through. We're going to see further volatility in the markets. But as long as we're not invested in the top end of the cap weighted indices, and invested in other things other than tech. Tech is not going to really like these tariff policies with higher inflation, a little bit lower growth. It's just not going to be a space that's going to be resilient. So as long as you're investing kind of away from that and investing in things with good fundamentals on the bond side, staying, in credits, the bond market right now, a double A bond is yielding just only like 0.1% less than a double B bond. So why would you own lower credits here, right? Just move up in credit quality. You're not sacrificing yield. And you can do a lot of things like that, which we're doing in our portfolios that are going to help us be resilient as we move forward. But we got to get through tomorrow. Tomorrow's Liberation Day. There's going to be a lot of tariffs announced tomorrow. We'll have to see how the market reacts to that. I think a lot of it's baked as long as there's no surprises. There could very well be some surprises tomorrow. I've heard whispers of pharma tariffs and some other stuff. And so, I'm going to have to just say the word tariff 1,000 times between now and probably the summer. And I think the summer is when we get this stuff kind of in place and maybe things cool down, and then we can kind of start to kind of game plan for the rest of the year. But for now, we're just going to have to strap in.
Yeah, no, that's great. And we are taking it a month at a time, folks. So hopefully you're tuning in here each month for updates. So, Brian, I want to come over to you. So, I think both you and I and all of our advisors here are hearing a similar story from our clients, which is concern related to what they're hearing in the news. So, year to date, the S&P's off 4.5%, Nasdaq's off 10.5%, and Mag 7's off 15.5%. So, it's certainly been a painful year in the equity markets. And our most recent experience with a year where it was down was 22, when also fixed income was off. And so seeing a fixed income market that's holding strong is certainly encouraging. That being said, our clients are still coming to us and sort of saying, hey, while we work through these tariff issues, should we just take less risk, go to cash? You want to talk a little bit about sort of how you're framing that with clients and the things you're talking through?
Yeah, thanks, Hunter. You're exactly right. I had a couple of calls last week and a couple of calls the week before about that very thing. Hey, Brian, should I just go to cash and just wait for all this stuff to play itself out? And my answer to our clients is an unequivocal no. Keep in mind that for those of you who have been listening to this thing for month after month after month and year after year, we've talked about the fact that we've expected some volatility even prior to this administration getting elected. But for this year particularly, we've expected this volatility and we've positioned the portfolios appropriately for that. So I think you can see the evidence in that when we look at our model performance. Hunter just mentioned that equities are down anywhere from, depending on what you're measuring, from 5 or 6% down to 10% down to 15% down if you're looking at the Mag 7. And our models just aren't. Our models are, in essence, holding their own. If they're not flat, they're down several basis points, but not even 1%. So we've built portfolios for this to protect, and that's why we didn't overweight in any one sector like technology, and we didn't overweight in any 7 stocks, for example. So I've been telling my clients, hey, we've already planned for this before it ever happened. You're starting to see the protection come through in our year-to-date performance numbers already. So I'm actually thrilled with how we're doing so far in this environment.
Yeah, it's great. As always, folks, as Brad mentioned, we've got more tariffs in all likelihood tomorrow, and continued sort of volatility as we head through April. So we'll be back in front of you at the end of April with some updates on the markets, our thoughts on things going into the summer. As always, thank you for your trust that you place in us at CWA. We'll see you in a month.